Hi everyone. So welcome to the stream today. Very much excited for having you. I see some of you joining with a comment in the chat box. So I'm going to read all of them. When you join the stream, give us a thumbs up on the video. That helps us a lot so that YouTube will be able to push the video so we can reach as many students as possible. And we are continuing with our accounting standard lectures, and we've discussed the overview of the standards on Tuesday. Then on Wednesday, we started with IAS 16. On Thursday, that was yesterday, we continued with it. And then today, we want to go to IAS 23, borrowing cost, and also touch on IAS 20, government grant. So in the chat box, you comment in the chat box with any questions that you have, wherever you are watching from as well, indicate in the chat box, and then let's see. So I see some comments there. Grace said, hi there, Grace from Netherlands. Okay, Grace. I hope you're doing well. Thank you for joining us. Jamel Imoro said, good to be back. Thanks, sir. It's always a pleasure. Good to see you, Jamel Imoro. So comment in the chat box any questions you have for me. And in case you missed the part 1, part 2, part 3 of the IAS 16 or this new season we started on Tuesday, the link will be left in the description to this video, and you will be able to watch that playback and also follow suit in the series that we are covering in the accounting standard lecture. So when you join the stream, give us a thumbs up on the video. I would want to see more thumbs up on the video, and then also share the video with your friends, your colleagues, and people that you know they will be interested in videos like this, who assist them to be able to prepare for their examination. All right. So let's go straight into our discussion for today. So we want to start with IAS 23, borrowing cost. So remember, I gave a list of the accounting standards and how they are interrelated and how we need to study them together. And we made mention of the fact that when it comes to the non-current assets, the standards there include IAS 16, IAS 20, IAS 23, IAS 40, IFRS 5. So these are all non-current assets accounting standards. And we started with the IAS 16, discussed the IAS 16 and all of the things that we need to understand about the IAS 16. So we want to move on to the second phase, and that is to look at IAS 23, borrowing cost. This is also another fundamental accounting standard that is closely related to the issue in relation to non-current assets. If you remember IAS 16, when we're dealing with the initial cost of the assets, in other words, what should constitute the initial cost of the assets, we made mention of the fact that as part of the initial cost of the assets, borrowing cost is also included in the initial cost of the assets. And I told you that we will be dealing with how that borrowing cost is computed, how it is capitalized later on in IAS 23. And this is where we are, and this is what we want to look out for. I see some of you coming. You are welcome to the stream. When you join, consider to give us a thumbs up on the video. That helps the video a lot. That is what the YouTube algorithm wants, and to be able to push the video so we can reach as many students as possible. And also it helps us to grow the channel and be able to render you much services as well. Chris Adu, I see you. You are welcome to the stream. I believe that you are doing well. If you join the stream, you can give a hi in the chat box, and then also let me know what questions you have for me, and I will be able to answer all of your questions as well in the chat box. Mustafa, I see you. You are welcome to the stream. All right. So let's get into the day's discussion, IAS 23, borrowing cost. Now, the objective generally of this standard is to prescribe the accounting treatment of borrowed funds or funds borrowed by organizations. Okay, the accounting treatment of the cost incurred in the arrangement of funds and interest expenses. All right. So when we go and borrow funds, the cost we incur in the arrangement of the fund, and then the interest expenses we incur on the fund that we are borrowing, how we account for that is what we refer, it's what is prescribed in IAS 23. Andrew Oponbeko, I see you. You are welcome to the stream. Believe that you are doing very well. Now, so if the objective of the standard is to account for how we treat or prescribe the accounting for the treatment of costs we incur in the arrangement of funds and the interest expenses, then what do we do and what do we look out for in this case? Now, remember I told you in the introduction that when we are dealing with accounting standards, a couple of things must come into consideration. Number one, we deal with the key definitions. We look at the recognition criteria, subsequent measurement, and then what? Disclosure requirements. But I told you that it's not all standards that we're going to be looking at how we're going to be following those things in that case. Mavis Nyangsin, I see you. You are welcome to the stream. Pius Ajiman, I see you. You are welcome to the stream. Okay. If you have any questions, drop them in the chat box for me as well. All right. So what is borrowing cost? I've indirectly defined that already. Borrowing cost simply refers to the cost that we incurred in the arrangement of fund, costs incurred in the arrangement of funds, of borrowed funds to be specific, and then what? The interest expenses on those funds. So the cost we incur in the arrangement of funds and the interest expenses on those funds, that is what we refer to as what? The borrowing cost. Now, our focus here is to look at how we can account for the borrowing cost, how we can treat them in the financial statement, and how we go about them. Usually, the benchmark rule is that when companies borrowed funds, and the general rule is that expenses incurred, like the cost incurred in the arrangement of the fund, and then the interest expenses, the borrowing cost in total must be written off in the income statement. That is the general rule. So the general rule is that the borrowing cost, let me do shortcuts, BC borrowing cost should be written off in the P&L account. So in a simple language, all costs we incur in arrangement of funds and the interest expenses we incur on it, what do? We write it off in the income statement. However, the standard gives an exception. Now, what is the exception? The exception is that if an entity borrowed funds and the funds is used for the acquisition or construction or building of a qualifying asset, then the borrowing cost must be capitalized. So let's take that again. Borrowing cost is supposed to be written off as expenses in the P&L account. However, where the fund borrowed is for the acquisition, construction, or the building of a qualifying asset, then the borrowing cost should be capitalized. That's very, very critical. So even though the general rule, even though the benchmark rule is we should write it off, when the fund is for the acquisition or the building of qualifying assets, then we need to capitalize it. So the question we then ask ourselves is, what is a qualifying asset? So what is a qualifying asset? In a simple language, we say that qualifying assets are assets that require substantial time in order for them to be ready for use or for sale. Qualifying assets are assets that require substantial time to be ready for use or for sale. So any asset that requires time to be ready for use, to be ready for sale, is referred to as what? A qualifying asset. And IAS 23 states that when we incur cost, the cost we incur in the arrangement of the funds, and then the interest expenses should be capitalized if it is for the acquisition, construction, or manufacturing or building of qualifying assets. I see some comments coming in there. Let's see. Chyla, your first name, I think I'll skip it so that I don't mention something. So Chyla, hi, I'm here all the way from Zambia. All right, Chyla, hi. Shout outs to Zambian people, all of you guys. And then this name will be hard for me to mention. Let me look at it here. Tayo, I don't know, I can't mention that name. Tabilin, Tayo, hi, Tabili. Then Zolak, I see you coming. You are welcome. Everyone, welcome to the stream. Give us a thumbs up on the video when you join, all right? So, two things we've mentioned so far. Number one is that the benchmark rule is borrowing cost should be written off in the P&L account. Then number two, we said, however, if the fund is borrowed or the fund borrowed is for the acquisition, construction, manufacturing, or building of qualifying assets, then the borrowing cost must be what? Capitalized. The borrowing cost must be capitalized. Now, so then what is qualifying assets? We say qualifying assets are assets that require substantial time for them to be ready for use or for sale. I see a comment coming in. Let me look at that. Adam said, how is substantial time defined? Substantial time simply means that it requires some time for the thing to be ready for use. All right? It requires some time. Now, it depends on what we are talking about here. If it is building, we are constructing a building, then definitely it requires maybe 2 years or 1 year or 6 months, whatever it is. If it is an inventory we are manufacturing, maybe it requires 1 month or 3 months or whatever it is. So substantial time is dependent on what we are producing or what we are looking out for in that case. I hope it makes sense. So Adams, that is the issue there. Tao said from Lesotho. Okay, shout outs to all. When someone is from Lesotho, how do we call them? So shout out to everybody there. And thank you for joining the stream. It's always a pleasure to have you guys around. Okay, so if that is the case, then we need to determine certain things. All right. If we borrow the funds and it's for the construction, the acquisition or manufacturing of qualifying asset, then we need to capitalize it. That means that, number three, there is another thing we need to understand. We must distinguish between the capitalization period and then the non-capitalization period. Oh. So we must distinguish between the capitalization period and non-capitalization period. Now, I'm going to explain this in a way to make it very simple for you to understand. So let's assume that we are constructing a building, all right? And so we started somewhere, and the building is for 2 years. Okay? So that is going to be the contract period. Okay? So the contract period, 2 years. That is the time it is going to be taking us to build the asset or to to build the asset or to finish building. And then let's say that, okay, 2 years. Then let's say that we started the work on 1st January, all right? And so 2 years is 18 months, 24 months, so 31st December of the period. And our year ended is 31st December. Now let's build up the knowledge here. The interest we capitalize, be careful here. The interest we capitalize should be the interest expenses incurred during the capitalization period. So follow me carefully. What is the capitalization period? The capitalization period is simply the period where there is active work on the project. The capitalization period is a period where there is an active work on the project. So there has to be an active work on the project for us to say that this is what? The capitalization period. So the interest expenses, which is being capitalized, is the interest expenses we are incurring in the capitalization period. Why is this important? because there is another period where there is halts in the project. So where there is halts in the project, then interest expenses we incurred during the halt period has to be written off. But let me explain this very well. Let me explain this very well so you understand the principle. I see a comment coming in there. Mustafa said, sir, please go over on the definition of borrowing cost. We said borrowing cost can be defined as the cost incurred in the arrangement of funds and the interest expenses. The cost incurred in the arrangement of funds and the interest expenses. So it has two components. The cost we incur to get the money, and then the interest expenses we are paying on the money. These two components is what is referred, or together is referred to as the borrowing cost. So Mustafa, I hope it makes sense. So what are we saying? So we are doing a contract, it's for 2 years. Does it mean that the interest expenses for the whole 2 years must be capitalized? Yes, it could be true. No, it cannot be true. So we need to determine first the capitalization period. And what are we saying? The capitalization period is the period where there is an active work on the job. There is an active work on the project. There is an active work on the building. Now, when there is haltage or stoppage in the production, then the interest expenses incurred during that period must be written off. Now, I'm about to drop a bomb. Make sure you get it well. There is also an exception to this rule. The fact that there is halt or there is stoppage does not mean that we need to write off those interest expenses. The standard states that if the halt or stoppage is necessary to enhance the usage of the product or to process the product to enhance its quality, then the interest expenses incurred during the haltage period must also be capitalized. So let's make sense of these principles, okay? Let's make sense of these principles. So number one, there is a haltage period, and this halt is because of the fact that we need to go. So let's make this. So we are constructing a building. And you know, when you're constructing a building, once you start construction, AMA will come after you. That is Accra Metropolitan Assembly. They will come and check building permits and all of those things. And then if they come and you're not able to show them instantly there and there, they will write stop work, produce permits, and they will require you to stop. Now, if we stop the project and going back and forth with AMA, it took us 3 months. That is a haltage period. The question is, during that 3 months that we've stopped the project, the interest expenses, do we write it off in the income statement or we capitalize it? Now, listen to this carefully. Now, since the permits and the regulatory authorities' permission is critical for us to finish the building, the interest expenses we incur during that 3 months period will not be written off. Instead, will be capitalized. Does it make sense? So a haltage, as a result of regulatory authorities' permission, should be what? Capitalized. Now, these are cases specific. Okay, these are cases specific. Number 2 scenario. Let's say that there was haltage because we did not pay our employees, so the employees go on strike. So employee strike action. So if our employees go on strike for say 2 months, so something happened, we didn't pay them, then they brought in placard, we won't work again, and it took 2 months for us to sit with them and then discuss the issue and pay them, then they resume work. The question is, listen to this carefully. The question is, the interest expenses we incurred during that period that we didn't pay them, do we write it off in the income statement or we capitalize it? For these kind of scenarios, the standard says that the expenses has to be written off. Are you getting the idea? So yes, there is a haltage, but the entity could have controlled that. The entity could have done something about that. So it is not necessary for the project. Hence, we have to what? Write it off. Next, shortage of raw material. Some of these things are a bit debatable issues because of the specific scenarios under consideration. Now, shortage of raw material. Listen to this one carefully. Listen to this one carefully. Usually, with shortage of raw materials, it is within the control of the entity. So when there is shortage of raw material, for whatever period that there is shortage, what happens is that the interest expenses is supposed to be written off in the income statement. It's supposed to be written off. However, if, for instance, the borders were closed by the government because of the pandemic and all of the issues running up, so the borders were closed, so we couldn't buy, or other countries also have closed their borders, and we couldn't buy from them, and we are waiting for them in that way, then that is outside the permit of the entity. For that reason, the interest expenses during those periods will be capitalized. So are you looking at the exception aspect of these things? Looking at the exception aspect of this thing. So on one level, it is written off. On another level, it has to be capitalized. This is very important in here. Then let's say that it rained. Okay, so natural disaster. Let's say natural disaster. What do? Natural disaster, we didn't cause it. So if there is any rain, earthquake, or whatever happened, and we need to wait, interest expenses incurred during those periods would have to be capitalized and not what? Written off. Would have to be capitalized and not written off. Then another thing is about quality control. You know that, for instance, if you are constructing a building with block and cement, or you are constructing a bridge or constructing a road, there comes a point where you need to stop. Or when you do the work to a certain point, you need to stop so that the thing dries, solidifies, everything is JJ, then you can now continue to build. Now, if the stoppage is necessary to enhance the quality of the product, the quality of what we are, the asset, then the interest expenses should be what? Capitalized. Okay? Then the interest expenses should be capitalized. That is the idea here. So these are just a handful of scenarios deciding that, yes, when there is haltage, we need to write off the expenses. But it is not all haltage periods that we write off. Some haltage periods would have to be capitalized because they are necessary to enhance the quality of the asset, or they are necessary because they are part of legal regulatory requirements that we need to follow. So that is what you need to understand about deciding what to capitalize, what not to capitalize during the haltage period. So let me give you an example of how all these actually make sense. I see some comments coming in there. Let's see. Let's see what we got. Hillcrest Accountant said, many thanks, Nhyira. You are welcome. Christiana, I see a do thumbs up in the chat. All right. Mohammed Sakib, thanks, sir. You are welcome, Mohammed. All right. Give us a thumbs up on the video when you join. And also comment in the chat box with any questions you have for me. Salah Gindo, I see you. You are welcome to the stream. Salah Gindo, I see you. I guess we have a number of people as well coming in. Netherlands, Zimbabwe, Lesotho, Zambia. Like we have people just coming in, Ghana, Nigeria. That's awesome. Like the blended coming in. But most importantly, comment in the chat box any questions you have for me. If there's something I said you did not get, well, just put it in the chat box and I can assist you much better there. Eric Asumenin. Hi, Eric. I hope you're doing well. Okay, so let me give you a scenario, like what I was building up here. So let's say we are constructing a building. So I'm going to pick up a question and then we look at the scenario in there. So KK Limited, all right, took a loan from NP Bank to construct an asset at a cost of $200 million. The interest rate on the at 15% interest rate per annum. The construction was for 2 years. The construction was for 2 years. Okay, so KK Limited took a loan from NP Bank at 15% interest rate per annum. The construction was for 2 years. The construction was for 2 years. Work began, the construction was for 2 years. Work began on 1st January 20X6, and the asset was ready for use on 30th June 20X7, 30th June 20X7, but was occupied on 30th October 20X7. Now, follow me carefully with this illustration, okay? Because I'm going to use this as a guinea pig to draw a lot of principles. I like to bring in the principles so that the questions, then we use them to explain the principle so we can follow suit. So let's see. KK Limited took a loan from NP Bank to construct an asset at a cost of $200 million at 15% interest rate per annum. The construction was for 2 years. Work began on 1st June 20X7, and the asset was ready for use on 30th June 20X7, but was occupied on 30th October 20X7. The requirement here is what is the initial cost of the assets and the interest expenses to be written off. What is the initial cost of the assets and the interest expenses to be written off? So let's look at it. So let me grab my Casio calculator. Okay. So remember, I wanted to make sure you follow suit here very, very well, because I'll reveal a lot of principles here. Okay, I'll reveal a lot of principles here. So stay with me very well. Let's go. The loan we have gone for is $200 million because the cost of the assets was $200 million, meaning that KK Limited was broke or something like that, or they were not having money to fund it themselves. So the whole cost of the asset was borrowed from NP Bank. Now, we are told in the question a couple of things, but we need to follow and find out what is really happening. So we are told that number one, the construction is for 2 years. But wait a minute. Construction began on 1st January 20X6, and the asset was ready for use on 30th June 20X7. Please be careful here. In the determination of capitalization period, the capitalization period ends when the asset becomes ready for use or ready for sale. Please get this very, very well. The capitalization period ends where the asset or when the asset becomes ready for use or where the asset becomes ready for sale, and not when they start using it. So if you look at the question carefully, you realize that the asset became ready for use on 30th June 20X7. But KK Limited, for some reason, started using the asset on 30th October 20X7. We don't care. We really don't care when they started using it. Our concern as accountants, our concern in accordance with IAS 23 is that when was the asset ready for use? So they began construction and the asset was ready for use on 30th June 20x7. So number one, we need to determine what? Our capitalization period. So solution, straight up here, and that's KK Limited. Very important to always put the name of the question up. So let's look at the capitalization period. So if you look at our capitalization period closely, you will realize that we are told a number of things. Nana Safo, I see a comment from Nana Safo. He said, "Sir, please clearly explain the interest expenses on capitalization and written off." I don't understand your statement. Clearly explain the interest expenses on capitalization and the written off. I don't understand your question or statement well, Nana Safo. So maybe you can restate it very well because it's too generic. I don't really know what you are driving at. So if you can explain yourself clearly, probably to help me.